Your bank's goal is to become wealthy. It's not for you to become wealthy, it's for the bank to become wealthy. I don't mean that you're not going to get approved for a mortgage. I mean you can't actually afford it for your own personal wealth. Even if home prices are slowing down, that doesn't mean the home prices are going down. What's up everybody, I am Jaspreet Singh from theminorityMindset.com, where money minds rethink rich. If you've been thinking about buying a home, especially in this crazy market, well there's a few things that you got to understand from the home buying process to the mortgage process, and I'm going to be going over all that in this video because I put together some of my best scripts that will help you understand everything you need to understand about buying a home. So let's get into it. Almost everybody wants to own their own home. Like 9 out of 10 millennials say that they want to be homeowners. But unlike what your cousin Bunty says, buying a home the right way isn't so simple. If it was, you wouldn't have so many home buyers regretting their decisions. I have seen real estate from a few different perspectives. I am a real estate investor, I am an attorney, and I have a real estate salesperson's license. I don't actively help people buy and sell homes anymore, but I used to. So if you want to buy a home the right way, there are 10 things that you need to know, and it all starts by smashing the thumbs up button below. I guess the thumbs up part isn't really necessary, but I would appreciate it because the way the YouTube algorithm works, if you do not hit that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. And when it comes to you buying a home, the first thing we need to talk about is getting pre-qualified, because the last thing you want to happen is you fall in love with a home and then you find out you can't afford it. You want to get pre-qualified before you start looking for a home because it'll give you an idea of how big of a home you should be looking for. I'll get to affordability a little bit later in this video, but this will kind of give you an idea and it'll save you time as a buyer, and it'll also save the seller time. Plus, if you're already pre-qualified to buy a home, then this tells the seller that you're serious and you'll have the cash ready to purchase the home, because the last thing the seller wants to do is take their home off the market because somebody wants to buy it, and then 60 days later they find out that this person cannot get the cash to purchase the home. So if you are pre-qualified, you are more likely to get accepted with an offer because you have demonstrated that you'll be able to get the cash to purchase the home. I learned this lesson the hard way. So I was selling an apartment complex that I was a part owner of, and a lady brought me an offer through my agent, and she was not pre-qualified at the time, but she said that she wouldn't have any problems getting the cash. So I thought, okay, no big deal. She has good income, she has their experience, she should have no problem getting pre-qualified. And so she negotiated a 60-day kind of contingency to get this financial pre-qualification, which is pretty standard in commercial real estate deals. And then 60 days go by and she says, oh, I'm having some issues with my lender and this is going to take another 30 days. Another 30 days go by and we have taken the property off the market at this time. So now we're talking about 90 days off market. 90 days go by and she's like, I'm starting to have some more issues with another lender, so I'm going to start the whole process over with a different lender. At this point, I was like, we have been off the market for 3 months and we have no idea if she's going to get pre-qualified. 1 month later, we find out that she cannot get pre-qualified, so now we're off the market for 120 days or something like that. And at this point, I was like, oh my God, so we just canceled the deal and we had to start the whole process all over again. It ended up working in our favor because we got an even better offer, but that's why I don't even like looking at offers anymore unless this person is pre-qualified to purchase a property, and it will give you extra negotiating room in your offers. The way you get pre-qualified is by talking to a lender. Now, what you should also understand is that some lenders are going to charge you a whole lot less on the same mortgage as other lenders, so you want to do some shopping around. And if you're looking for some more help on how to do this, our team has articles on how to find the best mortgage on our website, theminorityMindset.com, and I'll also link an article for you up here and in the description below. The 3 main factors that a lender is going to look at when it comes to getting you pre-qualified and getting you a mortgage are your credit score, your income, and your debt. If you just want to get a mortgage, the minimum credit score that you need is something like 620. Now, if you just have a 620 credit score, you are not going to get very favorable rates and you're not going to get very favorable offers from your bank. If you really want to get more rebates and get the best offers from your bank, you should be looking for a credit score of something like 760 and above. Next thing is they're going to be looking at your income. They're going to want to see your W-2s, your pay stubs. They're going to want to see how long you've been at your job or in your industry and how much money you're making. And they're going to want to see this for at least 2 years if you're working a job. If you're self-employed, if you have your own business, they're going to want to see even more than that. And then they're going to want to look at your financial statements. They're going to want to see how much debt you have. And they're going to want to know if you have any credit card debt and all the different types of debt, because they're going to compare this to your income using something called a debt to income ratio. Essentially what the bank is doing is they want to see if you are a good investment for their money. So they're just looking at the numbers and they're gonna see, okay, this person's making a lot of money, they don't have a lot of debt, and they have a good credit score. Yes, they're a good investment for our money, and we don't have to charge them too much in fees because we think they're a good investment. But if they look at you and they say, ooh, this person has a lot of debt, their income is fine, but their credit score is also low, they don't seem as good of an investment, so we're gonna have to take an extra risk. So we're gonna charge you extra fees to make up for this higher risk. So if you wanna get the best rates, you want to work on lowering this debt, you wanna work on increasing your credit score, and you wanna work on showing the bank that you have a steady stream of income. Second, let's talk about affordability, because if you're subscribed to our YouTube channel, you know the motto. Just because you can qualify to buy something does not mean you can afford it. And if you're not subscribed to our YouTube channel, you should probably do that. To really understand this, you have to look at real estate from different lenses. So let's start by looking at it from your real estate agent and your mortgage broker's perspective. Your real estate agent and your mortgage broker, they want you to buy the best home possible, which many times means the most expensive home possible, which also coincidentally means the biggest commission check possible for your real estate agent and your mortgage broker. Your wallet, on the other hand, wants you to buy the smallest home possible because that's going to keep more money in your bank account. And your Instagram page wants you to buy the home that you can't qualify for. Being able to afford your home comes down to three different things. It means affording the down payment, it means affording your monthly payment, and it means affording the closing costs, because a lot of times people forget about this. Starting with your down payment, when you buy a home, you gotta put some money down, and the amount of money you pay is gonna depend on what kind of mortgage you get. Typically, this is going to be something like 3 to 20% of the home value. So if you're buying a $100,000 home, we're talking about $3,000 to $20,000 down. If you go out and you get an FHA mortgage, so this is something that has lower qualifications, you can put down 3.5%. But because the qualifications are a little bit lower, the bank is going to look at you as a more risky investment, and they're going to charge you a higher interest rate, and you're also going to have to pay an additional fee called PMI. PMI stands for private mortgage insurance, and it's a fee that you have to pay if you do not put down 20% or more on your home. So the bank makes you pay this fee, they make you buy this insurance because the bank thinks that you're a higher risk investment, because there's a higher chance that they'll have to foreclose on you because you have less skin in the game. But what you have to understand about PMI is that it is not insurance for you. It's insurance for the bank. So the bank is making you buy their insurance because they think, or they're worried, that there's a chance that they'll have to foreclose on you. In order to compensate for that risk, the bank makes you pay an extra fee. So if you do not put down 20%, you're gonna have to pay higher fees and you're gonna get a higher interest rate. That's why if you wanna be able to afford the home, I want you to have at least 20%. That way now you can buy the home, you can have more equity, you won't have to pay PMI, and you can get the better interest rates. Second, when it comes to your monthly payments, lots of times banks will say that your monthly payment should not be more than a third, 33% of how much money you're making. Now, I have seen in some instances that means how much money you're making before taxes, and in other instances, I've seen that mean 33% of what you're making after taxes. I want you to be a little bit safer here, and I don't want you to buy a home unless you can afford the monthly payment 4 times over with your net pay. That means your monthly payment should not be more than 25% of your actual take-home monthly pay. So if you're taking home $4,000 a month after taxes, your mortgage should not be more than $1,000. And finally, we have to talk about closing costs. So typically, this is going to range somewhere between 2 and 4% of your home value, depending on all the different things that you're getting and the insurance that you're getting and your mortgage. So you have to just remember that when you go to actually purchase the home, there are extra fees you have to pay. So if you're buying a $100,000 home, yes, $2,000 to $4,000 in additional fees. A lot of times people forget this, and what do? They take these costs and they put them on the back of their mortgage, and now you have to pay interest on these things. Know what the closing costs are. That way you can prepare for it and have the cash to afford these things. And one thing that I also don't want you to forget when it comes to closing costs is your moving costs, because guess what? It costs money to move. If you're going to use a moving service or anything like that, there is a cost to move from one home to the other. So just don't forget that. Third, should you use a real estate agent? So you need to understand that there's 2 different types of agents. You have buyer's agents and then you have listing agents. Buyer's agents are the ones that help you find the home to buy. Listing agents are the ones that help sellers sell their home. The way it works is if I'm selling my home through a real estate agent, I'm going to find a listing agent and I'm going to tell them, okay, you sell my property, and when you do, I'm going to pay you a 6% commission on the final sales price, but that commission is going to be split by you, the listing agent, and the buyer's agent. So the commission for your buyer's agent is paid by the seller, but the seller is paid by you. because the money that I get, the seller, is going to be paid by you because that's the money you're paying me to buy the home. So you're paying me to buy the home, and then I'm paying both the listing agent and the buyer's agent. This is where people say that, okay, so if I go and buy a home without a buyer's agent, then the seller won't have to pay as much commission because now there's only a listing agent, not a buyer's agent. And so maybe the seller can discount the price of the home because now they don't have to pay as big of a commission. Sometimes that works, but a lot of times what listing agents do is they already pre-negotiate this with the seller, where if there's a buyer's agent, you're going to have to pay 6% commission, which is going to be split 3% by the buyer's agent and the listing agent. And if there is no buyer's agent, then the listing agent will take 5% commission instead of 6%. It doesn't always work like that, but sometimes it does. Plus, your buyer's agent can also save you a ton of headache and a ton of time. And if they're a good agent, that can also help you out with the negotiation to help you save more than that 3% when it comes to actually buying the home. So if you find yourself a good agent, their service will pay for their fee by itself. And if you find yourself a bad agent, well, now you're paying a premium for something that you don't necessarily need. Fourth, you gotta know what you want, because when it comes time for you to buy a home, this is not like Chipotle where you can go to the checkout counter and say, oh wait, I forgot to get extra guac. When it comes time for you to buy a home, you gotta know what you want before you get to the checkout counter. Not only do you wanna know exactly what you want in a home, but you also wanna kind of prioritize what's important and what's not as important, because there's a chance that you might not find everything that you want when it comes to buying a home, but you need to know what's very important and kind of make sure you prioritize those as opposed to the things that are not as important. So some of the things that you can pay attention to are the size of your home, the yard. Do you want a yard? If so, how big does it need to be? Maintenance. Sometimes you're going to find good deals on homes that need a lot of work, but is that something that you want to do? Schools, the school district. If you have kids, you want to know what kind of schools they're going to be in. The neighborhood, is it a good area for you to be in? Is it close to highways if you got to commute to work? How many bedrooms and bathrooms do you want? And what about the basement? Do you want a basement? Does it need to be walkout? How big does the basement need to be? Does it need to be finished? You might not know everything you want in the beginning, but as you start going through homes, start creating this list and prioritize what's most important and what's not as important, but you would like these things. That way you can tell your agent, that way they can show you the homes that fit your criteria. It will save you a ton of time. Fifth, when you finally find a home that you like, now is time to make the offer. This is where things get fun. So homes are a little bit different than other purchases like investments, because now you might not necessarily be trying to get the best deal because the home has more emotional value, right? This is the place where you want to build memories. It's where you want to raise a family, and it's where you want to be. It's not just something that you want to buy cheap, that way you can flip it for a higher price. So when it comes time to buying the home, you don't necessarily always have to try to get the best price possible, because if you really love a home, you want to make sure you get it. That being said, I also don't want you to overpay for the home. And so if you want to make a good offer, you need to first understand what kind of market that you're in. Are you in a buyer's market or a seller's market? When you're in a buyer's market, now there's a ton of inventory, homes for sale, but there aren't that many buyers. When you see that happen, you're going to see sellers cutting their prices, trying to get more buyers looking at their homes. And when you're in a market like that, you're going to have way more wiggle room on the price. In a seller's market, the seller has the upper hand. Now there's a ton of buyers, but not as many homes for sale. And this is when you see home prices going up. When you're in a seller's market, now the buyers have to compete against each other to buy the home. So if you're in a buyer's market, you're typically going to have more leverage and more negotiating room, so you can be more aggressive with your offer. If you are in a seller's market, you might not. You might have to pay full asking price, and sometimes even more than asking price if you're really in a strong area, if you really want to buy that home. There's been situations in seller's markets where I've made an offer on a property and the seller would say, oh no, this is too low, we have another higher offer. And I will say, okay, take that. And then 30 days later, they have called me and said, oh, this other buyer backed off because they couldn't get the cash. Will you still be interested in buying the property at the original offer that you made? So that has happened where I have been rejected, and then they called me back to buy the home because it was the type of market that we're in. In a seller's market, it is completely flipped. I have paid more than the asking price to buy certain properties that I want to own, just because that's the market that we're in, and I need to be competitive in order to make sure that I get the property. This is where having a good real estate agent can really come in, because they should understand the market and they'll know based off of the neighborhood that you're buying in what type of offer you should come in. That way you can get the best deal possible. If your goal really is to get the best deal possible, then the best negotiating tip is just to be willing to walk away, because if you don't get the price you like, then walk away and find another deal. The last tip I want to give you when it comes to making the offer is the time of year that you buy a home, because if you're buying a home in the summer months, especially if you live in a northern state where it's colder, then that's when it's going to be the busiest season for real estate, and that's when you're going to see the most buyers out there, and that's typically when you see the highest prices of homes selling, because there's a lot of people buying homes. In the winter months, people just don't want to leave their house, and so you're going to have less competition, so you can get a better deal in the wintertime typically. But again, it just depends on what kind of home you want, because you'll see more inventory in the summertime, and typically you'll see less inventory inventory in the wintertime, so if you don't find something you like, you might have to wait till the summer. Once you get your offer accepted, that's when it's time for number 6, giving your EMD. So EMD stands for your earnest money deposit. It is essentially your deposit, and it shows good faith that you're actually serious about buying the home, because if you walk away without any reason, you will end up forfeiting this EMD, this deposit, to the seller for wasting their time. However, that being said, if you put down this EMD, you give this deposit to your agent, and then you go through the home and then you realize, ooh, this might not be the home that I really want, you can get your money back as long as you do it within the contingency period. So when you're negotiating a contract, every contract should have a minimum 10-day contingency period that says that you have the opportunity to go through the home, do inspections on the home, and really just make sure that this is the home that you want. If you have that contingency period there, then you have the opportunity to get your money back as long as you do it within that contingency period. If you decide the day before closing that now, I just don't want to buy this home anymore, or I don't really think this is the right home for me, and you're past that contingency period, then yeah, you are going to lose this deposit. The amount of money that you have to pay for your deposit is going to vary state to state, but a kind of good rule of thumb to remember and kind of a good negotiating tool is, if you really want to look serious and you want to make your offer more enticing, put down a bigger deposit. This is something that I do when it comes to buying investment properties, is if I really want to show this owner that I'm interested and that I can close quickly on this home, then I will just increase this EMD to a big chunk of the home value. That way I can show them, hey, I'm interested and I'm ready to buy this property very quickly. So if you find a home that you like and you really like it, you might want to consider raising your EMD a little bit to make your offer look more attractive. And remember, you can get this money back as long as you request it during that contingency period if you find something that you don't like or if you change your mind. But before you do that, make sure you talk to your real estate agent and confirm this with them, and maybe talk to an attorney too, because the last thing you want to do is run into an issue where the agent messed up on the contract and that contingency period is not there. So make sure you talk to your agent and maybe an attorney to confirm that this contingency period is in your contract. Now, once you enter into contract to buy the home and this contingency period starts, what you want to do is your due diligence. So what that means is you want to go through this property with an inspector and make sure that there's nothing wrong with the property, or at least nothing major wrong with the property, because one thing that I can tell you, that when it comes to real estate, things break. So what you want to do is kind of minimize how many things break by knowing exactly what's wrong with the property before you buy it. At the very least, you want your private property inspector to walk through the entire property and the roof to make sure there's no major issues with the property. You also want to maybe take a look at mold and your sewage system and your electrical system and your plumbing system. These are kind of extras, but the more cautious you are, the more money it can save you down the line. I can guarantee that your inspectors are going to find things that are wrong with the property. That's what you're paying them to do. You're paying them to find things that are wrong. What you want to really know is how big or a deal these things really are. And what you can also do, as a little negotiating tip, is when you get this list of kind of repairs or issues with the property, you can use this to go back to the seller and say, hey, there's a bunch of issues with the property. Either you can lower the price of the home by $5,000, or you can spend $15,000 to fix these things. It's up to you. When you do this, it helps to just talk to your real estate agent, because they're going to know how to do this the right way. Once you enter into your contract to buy a home, you're also probably going to start working with a title company, if not an attorney, to help you with the actual purchasing process, because their job is to look at the records and make sure that there's no back taxes on the property or back liens, meaning loans on the property, because the last thing you want is to buy a property and then 6 months later find out that there's a $30,000 loan attached to the property that you now own. I highly recommend you go through a title company, because a title company is going to give you something called title insurance, which protects you against them missing something on your records. I'll show you why this is important. One time I was part of a deal where we bought a multi-unit property, and it had a lot of land and it was on a lake. And so when we bought this property, there was no issue with the records. But a year after buying the property, I got a letter, or actually my attorney got a letter in the mail saying that this lender had foreclosed on our property, or a portion of our property, because apparently there was an old lien, an old loan on the property that our title company didn't see. So now we were like, what the heck, what do we do? Because this old lender had a loan on our property that we didn't know about. So obviously nobody was paying it. The last seller didn't tell us about this. And so because nobody was paying this loan, because we didn't know about it, then this lender then foreclosed on a portion of our property. That's when we went to the title company and we say, hey, what the heck? You guys missed this record. So the title company paid off the old lender, I think it was like $100,000, to make that old loan go away. That way we can own that whole property again. If we did not have title insurance, and if we did not go through a good title company, that would have been a very, very, very big headache. So you want to make sure you're going through a title company. That way you can get title insurance. That way they can look at the records and protect you just in case they miss something on the records. This brings me to number 9, talking about the legal stuff. Now, I might be a little bit biased biased here because I am an attorney, but using an attorney is a small cost you can pay today that can save you a big headache and a big cost in the future. What you're paying your attorney to do is to review your contract to buy the home because your real estate agent is not an attorney, and you're paying them to go through your title documents and your closing documents to make sure that your title company has reviewed everything and to make sure that you're protected in every way possible. If your attorney that you're working with is involved in real estate, they might also tell you that they recommend you getting a survey or an environmental study done. What these two things are two additional kind of inspections on your property. A survey kind of goes through the records to see what actual land that you're buying, because sometimes you think you're buying a plot of land, but you're only actually buying a quarter of that land or 3/4 of that land. So a survey is when people go out and they really measure the actual dimensions of the property, and an environmental is where people go out there and they're going to look at the soil samples and they're going to make sure that there's no other toxins in the land of the property. From an attorney's perspective, it is always better to be safe than sorry. Now, practically speaking, if the home that you're buying is in the middle of a subdivision, you probably don't need an environmental. Don't quote me on that because there's always an exception to this, but most likely probably not. And in terms of a survey, this is going to really help you figure out where your property line ends and where your neighbor's property starts. So if your property has like a funky kind of layout with a lot of properties around it or different types of properties around it, then you definitely should have a survey. If you are kind of just in a regular neighborhood, then you might not have the real need for it. But again, talk to your attorney about how important he really thinks it is, because he or she should give you an honest answer on whether it's really important, kind of important, or not that important. Once you get past all of this, now you're finally at the closing table where you're going to sign the paperwork and get the keys to the property. If you've done everything else that we talked about, then there's going to be no surprises at closing because you're going to review the closing documents before you get to closing, and all you're literally going to do there is just sign a bunch of paperwork. One tip that I do want to give you when it comes to closing is sometimes what you'll see happen is, let's say you're closing on the property on September 1st. Sometimes the seller's going to say, yeah, you're buying the property on September 1st, but we, the sellers, are going to continue living in this property until September 10th. If that's the case, what you want to do is you want to negotiate some sort of per diem that your seller has to pay for living in that property, because the last thing you want is come September 10th, the seller says, oh, sorry, we're going to take another 30 days to get out of here. So you need to make sure you have some sort of per diem there where they're going to pay you a certain amount of money for every day that they're there. And if they don't leave by the deadline, then the amount of money they're going to have to pay goes up. And you want to also make sure that some of this money is held in escrow. This is something the title company can do for you. That way now, if they don't leave, the title company is not going to give the seller their money because they are going to hold that money until the seller actually leaves the property. The last thing you want is, if the seller is staying in the property after the closing date, that they just don't leave, or that they take forever to leave. So you want to make sure you're compensated for that if that happens by talking to your title company and talking with your agent to come up with a plan to make sure you're compensated if, I'm not saying it is going to happen, but if it happens, you want to make sure you have a protection plan. Now, before I get into the next clip, I do want to let you know that if you are interested in learning more about how you can start generating passive income, our team has put together an amazing guide that walks you through different passive income strategies. That way you can start putting your money to work to start generating you passive income right now. So if you want to read this guide for free, I got the link to how you can download this guide and get our free daily newsletter by using our link in the description below. Buying a home is exciting and it's a big deal, but the process isn't always straightforward. You gotta deal with real estate agents, bankers, title companies, property inspectors, and because homes are so expensive, if you don't know what you're doing, you could end up way overpaying. I've seen real estate from a lot of different angles because I used to be a real estate agent, I'm a real estate investor, and I'm an attorney. Now, I'm not gonna go over the steps on how to actually buy a home in this video. I already made a video on YouTube where I went over how to do that exactly. If you wanna watch that video, I will link it for you in the description below. But in this video, I want to go over the things you need to understand about getting a mortgage. If you want to buy a $400,000 home, chances are you don't got 400 grand just sitting at the bank that you can use to buy the home. So you're going to work at the bank to get a mortgage. That way you can actually buy the home. But you want to make sure you're not getting taken advantage of by your bank. There's 5 things you want to make sure you understand when you're getting a mortgage. And I'm going to go over all 5 of these things in this video. So make sure you watch this video until the end. But before I get into that, I need you to do me a quick favor and mortgage that thumbs up button below. Before you go out and actually start looking at homes and making an offer, the first thing you want to do is get pre-qualified and get prepared to actually getting a mortgage. All getting pre-qualified means is that you've worked with a lender or a banker to get the basic credit process done. That way the bank or lender can see if they're willing to give you a loan. If you're not pre-qualified, you don't look like a serious buyer. because I can tell you from personal experience, it is a major headache working with somebody who's not pre-qualified, because if you fall in love with a home and you put an offer and it gets accepted, and now you have to kind of get pre-qualified and get approved to get a mortgage, and you can't do that, it is a major hassle, because now you're wasting your time, you're wasting your real estate agent's time, and you're wasting the seller's time. I was selling an apartment complex that I was a part owner of, and a lady brought an offer to me. The problem was she was not pre-qualified, but she gave me a pretty good offer. Now, the real estate agent I was working with kept saying, oh, don't worry, Jaspreet, she has a lot of money, she's really successful, she'll have no problem getting a loan. So I thought, okay, fine, I'll let this one go. So now we're in contract. I take my property off market, and a month goes by, she couldn't get approved for a loan. 2 months go by, she couldn't get approved for a loan. 4 months go by, and she could not get approved for a loan. At this point, we had to cancel the deal, and I had taken the property off market for 4 months, and it was just a huge waste of time on my part, on my real estate agent's part, and her part. As soon as you get pre-qualified, you automatically have an edge over other buyers who are not pre-qualified, because if I'm selling a home and I get 2 offers, one is from somebody who's pre-qualified and one is from somebody who's not pre-qualified, and you're pre-qualified and your offer is slightly lower than this person's, I'm still gonna take your offer even though it's less money, because it's less headache and less uncertainty, because you've already gotten pre-qualified. Part of the pre-qualification process is you getting prepared to actually get a mortgage, because, well, getting a mortgage is kind of a difficult process. You're essentially kind of selling yourself to the bank, and you want to show the bank why you're a good investment for their money, because if you can show the bank that you're a good investment, they will reward you with a lower interest rate. First, you got to show the bank your proof of income. So you might need to show your tax returns, your W-2s, your 1099s, whatever income that you have, at least for 2 years steadily. You need to show this to the bank. That way the bank can see that you're making money consistently. Second, you want to show the bank any assets you might have. So maybe you own some real estate investments or stock market investments or other assets. You want to show this to the bank so you can show the bank what you have. Third, the bank is going to want to know what debt you have and how much debt you have. Your debt to income ratio is literally just a fraction, where banks look at how much debt you're making and they divide it by your income. So nowadays, banks typically like to see a debt to income ratio of less than 36%. So they want to see that your debt is less than 36% of your income, and out of this 36%, they typically don't want to see more than 28% for your mortgage. So this is how much your mortgage should be max, and the rest of it can be your credit card debt, your car loans, or whatever. This is how much banks ideally want to see, but sometimes you'll see banks stretch this total debt to income ratio from 36% up to 43%. So if you have a lot of outstanding debt, credit card debt, car loans, it's going to be harder for you to qualify for a mortgage. So you need to work right now to pay down that debt. That way you can lower your debt to income ratio. The fifth thing your bank or lender is going to look at is your credit score. You can get approved for a mortgage with a credit score of 620 or higher, but if you have a 620 credit score, you're gonna have to pay a lot more fees and a lot higher interest rate, because the bank's gonna look at you like a riskier investment. If you wanna get the best interest rates and not pay these extra fees, you wanna have a credit score of at least 760 or above. If you're looking for ways to boost your credit score, you can use a credit card strategically, and you can work to pay your bills on time. If you wanna learn more about how to actually boost your credit score, I'm not gonna go over that in this video, but our team wrote an article on how to do that on our website, theminoritymindset.com, and I'll link it for you in the description below. The second thing you need to understand about mortgages are the different kinds of mortgages out there, because not all mortgages are created the same. First, let's talk about the differences between a fixed rate mortgage and an adjustable rate mortgage, an ARM. So fixed rate mortgages are very straightforward. If you go to the bank and tell them you want a loan, they might say, all right, this mortgage is going to cost you 2.8% a year, and if you agree to that for the next 30 years, you're going to be paying 2.8% a year in interest on your mortgage, and that's it. It's not going to change. Whether interest rates go up or down, this is the interest rate you are going to pay, and you have a set monthly payment. With an adjustable rate mortgage, it's not like that. With an ARM, the amount of money you're gonna pay on your mortgage is gonna change depending on what interest rates are. So one type of ARM that became very popular during the 2008 crash was the 228 ARM. What that means is during the first 2 years of your mortgage, you're gonna have a very low introductory teaser interest rate. So during the first 2 years, your monthly mortgage payments are very low. Then after that, your interest rate is gonna change every 2 years depending on what interest rates are. So if interest rates go up, then your mortgage payments are gonna go up, and that's gonna change every 2 years for the next 30 years. So you don't know what your mortgage payment is gonna look like in 5 years or 10 years, because you don't know what interest rates are gonna be. If interest rates go up, your mortgage payments can go up. Another example of this is the 5-to-1 ARM. What this means is during the first 5 years of your mortgage, your interest rate is fixed, and then every year, every 1 year after that, your mortgage rate is gonna change depending on what interest rates are. And then the 5-by-5 ARM says that during the first 5 years of your mortgage, your interest rate is not gonna change. but then every 5 years after that, your interest rate is going to change depending on what interest rates are. ARMs can be good when you're in an interest rate environment where you think interest rates are going to go down. But right now, we are in one of the lowest interest rate periods in history. It doesn't make sense to get an ARM when interest rates are already lower than they've ever been. In the future, the only way interest rates can go are up unless we go negative interest rates, but even then, we're already seeing the lowest interest rates in history, and we saw what happens if you tie yourself into an ARM and then interest rates go up, because that's exactly what happened in the 2008 crash. Everybody was getting into these 228 ARMs thinking that they were getting this amazing low teaser rate for the first couple of years, and then real estate prices came down and people couldn't refinance, and now everybody's mortgage payments were way higher than they anticipated, so people started foreclosing left and right. So ARMs can be good, hypothetically, when you're in an interest rate environment where interest rates are going down, but they come with their own fair share of risk. You can mitigate that risk just by getting a low fixed rate mortgage, and now you know exactly what your mortgage payments are going to be for the entire length of your mortgage. You have two main categories of mortgages. You have conventional mortgages, and then you have government mortgages. Government mortgages is money coming from the government, and conventional mortgages are not. That's the main difference. But the way these different types of mortgages play out is a little bit different when it comes to your down payment and how high your interest rate is going to be, so you really want to understand the differences. So starting with the conventional mortgage, you have a couple different kinds. You have conforming mortgages, and then you have non-conforming mortgages. All the difference is how big your mortgage is. Fannie Mae and Freddie Mac set what the limit is for a conforming mortgage, and if you get a mortgage that's bigger than that, it's called a non-conforming mortgage, and then you need something called a jumbo loan. So the difference between these two types of mortgages is really just how big your mortgage is. In 2021, the limit for a conforming mortgage is right around $550,000 for your mortgage, unless you're in a really big city like New York, where now your mortgage limit is a little bit higher. But if you get a mortgage that's smaller than that, you will get a conforming mortgage. If you need a mortgage that's bigger than that, then you're going to need a non-conforming jumbo loan. If you qualify for a conventional conforming mortgage, then you can get a home with a down payment as small as 3%. Now, if you put down 3%, you're going to have to pay additional fees like PMI, which is private mortgage insurance, where you're essentially buying insurance for the bank just in case you foreclose. But just understand that you can buy a home with a low down payment, however, it's going to cost you a little bit more in fees. With a non-conforming mortgage, so if you're getting a larger loan, a jumbo loan, then you're not going to typically get a down payment that's as small as 3%. You're going to have to pay a larger down payment because the bank is risking more money on you, so they're going to want you to put more skin in the game. Once you have 20% equity in your home, or if you put down 20% equity when you buy the home, then you can wipe out PMI. So until you have 20% equity in your home, you're going to be paying that additional fee called PMI with a conventional mortgage. And the advantage with a conventional mortgage over government-based mortgages is typically you get a lower interest rate here because you have a higher credit score requirement. So it's a little bit more difficult to qualify for a conventional mortgage than it is for a government mortgage. Now, moving on to government mortgages, the first type of mortgage is the FHA mortgage. So FHA is the Federal Housing Association, and the whole point of these FHA mortgages is to help people qualify for a home and mortgage who don't have the best credit score and who might not be able to put down a lot of money as a down payment. So to qualify for an FHA mortgage, you need to only have 3.5% as a down payment, and you can qualify for an FHA mortgage in some instances with a credit score lower than 620. Now, the downfall with this is FHA mortgages come with higher interest rates and higher fees. So because lenders will kind of look at you more as a risky investment, you're going to have to pay the price. And so one thing you're going to have to do is you're going to have to pay an upfront insurance fee when you get an FHA mortgage. And then you're going to have to pay an insurance fee on the back end for the life of your mortgage. So it's not PMI like you have to pay here. It's a different type of insurance, but you have to pay this additional fee in addition to your regular mortgage payments just because you're getting an FHA mortgage. The difference between the insurance fee that you have to pay with an FHA mortgage every single month and this PMI that you have to pay here if you don't have 20% in equity in your home is once you have 20% equity in your home with an FHA mortgage, you have to keep paying that fee. So this fee doesn't go away once you have 20% equity versus PMI goes away here once you have 20% equity. So the whole idea is these government mortgages can help you get a home, and then once you can qualify for a conventional mortgage, you can refinance out here and get one of these. That way you can pay a lower interest rate and pay less in fees. Second is the USDA, United States Department of Agriculture loans. These are more for rural homes. This is for people who are lower income or moderate income. This allows you to buy a home with 0% down payment in certain instances. residences. So you can buy a home with nothing down, but again, you got to pay higher fees. You're going to have to pay another insurance fee with your mortgage here, and that does not go away once you have 20% equity. So once you have 20% equity, it might make sense for you to refinance and get another loan here, depending on what interest rates are. And third are your VA loans. This is for military personnel and people who were in the military. So VA loans let you qualify for mortgages with 0% down, and these can be typically lower interest rate mortgages. However, because you're getting a lower interest rate and because you're putting 0% down, you have to pay a higher upfront fee here, an insurance fee with the VA mortgage, than you see here or here. So to qualify for a VA mortgage, you have to be a part of the military or have been a part of the military, and then you have to pay that additional fee in the beginning. But with the VA loan, unlike FHA and USDA, you don't have that ongoing insurance fee. So these government mortgages can help you qualify for a home, but with an FHA and USDA mortgage, you might have to pay higher fees during the life of your mortgage. So it might make sense for you to then refinance into a conventional mortgage, again, depending on what interest rates are when you're looking at refinancing, because then you can save some money on your interest rate mortgage and you might not have to pay some of these insurance fees. Third, you got to understand what changes your mortgage rates. There are 5 big factors that affect your interest rates, and we've gone over 4 of them. So one of them is whether you're getting a fixed rate or an adjustable rate mortgage. Second is what interest rates are. These are set by the Federal Reserve Bank. Third is how much your credit score is. Fourth is how much money you're putting down. And fifth is how long your mortgage is. To understand this, you really got to look at it from the perspective of the bank. So banks have all this money, and when they loan this money out, it is an investment for the bank. So the riskier the investment is for the bank, the more money they're going to want to see as a return. So if you're asking for a risky loan, the bank is going to want to charge you more money. And one of the ways to qualify a riskier investment is how long you want to borrow the money for. The longer the bank has to go without their money, the riskier the investment is. And so when you compare a 15-year mortgage with a 30-year mortgage, a 30-year mortgage is going to seem a little bit riskier for the bank because their money is going to be with you for 30 years. And so the bank is going to charge you a little bit higher in interest. With a 15-year mortgage, the bank is going to get their money back in 15 years, not 30 years. And so they can charge you a little bit less in interest because it's less risky for the bank. This is where you have to make more of a personal financial decision, because when you get a 30-year mortgage, you can buy a bigger home and have a smaller monthly payment because your payments are extended over 30 years instead of just over 15 years. So if you look at the same mortgage over 30 years or 15 years, your 15-year mortgage is going to have a lower interest rate, but your monthly payments are going to be higher because you have to pay the mortgage off within 15 years. If you extend it over 30 years, your monthly payment is naturally going to be smaller, so you can qualify for more home. One thing that you can also do to help you with your mortgage rate is just shop around. It's crazy how many people don't do this. They just go to the bank that they normally go to for their mortgage without shopping around. Some lenders are going to charge you a whole lot less in interest for the exact same mortgage. So it is in your best interest to shop around and make sure you're getting the lowest interest rate on your mortgage. There's really no excuse not to shop around anymore, because you can shop around on the internet for your mortgage and it only takes a few minutes. If you want to learn more about how to do that, our team put together an amazing guide that walks you through how to get the best interest rate on your mortgage or refinance. So if you want to learn more about how to do that, I will link the article for you in the description below. Fourth, when it comes to getting a mortgage, it is your job to know what you can afford. It is not your real estate agent's job, and it is not your bank's job. Your real estate agent's job is in the business of selling you a home. Your banker's job is in the business of selling you a mortgage. It is in both of these parties' best interest to give you the best home, which is typically the biggest home, which is also the home that's going to give these two parties the biggest commission check. Now, your job is to know what you can afford for your wallet. Just because you can qualify for $1 million home doesn't mean that you can afford it, and it doesn't mean that you should buy it. It's funny, every time I say this, I get these kind of angry messages from bankers or real estate people because I'm telling you to buy what you can afford, not buy what you can qualify for. And so that's not good news for the real estate agent or the banker. But let me show you what I mean. When it comes to affording a home, there's 2 things you have to look at. You have to look at the down payment and then the monthly payment. Your real estate agent and your banker's job is to get you into the home. So they're going to do whatever they can and pull whatever strings they can to get you into a home, even if you can't necessarily afford it. So when it comes to the down payment, a lot of times they're going to try to push you into a home with 0 to 5% down. That way you can get into that home of your dreams. Now, just because you can get into a home with 0% down or 5% down does not mean that you can afford it. If you really want to be able to afford your home, you want to be putting down 20%. Now, I know that's a lot of money. You want to buy a $300,000 home, that's $60,000 in cash you got to put down. But if you really want to be able to afford a home, you need to be putting down 20%. When you put down 20%, now you don't have to pay the higher fees, you don't have to pay the higher interest rates, and you have more equity in your home. when it comes to your mortgage payment, your monthly payment, your bank is going to say that they want your monthly payment to be something like 28% of your gross take-home pay. So this is before taxes. So if you take your total take-home pay before taxes, 28% of that should be your mortgage. I don't want you to pay that much money towards your mortgage, because then on top of that, you got to pay your taxes, you got to pay all of your other bills, your utility bills, your car payments, everything else. I don't want you to do that. So what I want you to do is I want your monthly payment to be 25% of your actual take-home pay. So you take the money you're making, you pay your taxes, and now out of what's left, 1/4 should be the maximum how much you're paying towards your mortgage. When you do that, you will leave enough money for your savings and for your investments. That way you can work to build yourself wealth instead of having all of your money going into the bank to make the bank rich. I want you to use your money to make yourself rich by paying a maximum of 25% of your take-home pay to your bank, and then using as much as you can to invest and save in your own wealth. Now, I know this might mean you might have to work a little bit harder to own a home, you might have to buy a little bit smaller home, and you might have to save more money for your down payment. But you are going to sleep a whole lot easier knowing you're not stretching yourself too thin to buy this dream home that you can't even afford. Now, you're using your money the right way, that way you can make yourself rich instead of just your banker richer. The fifth thing that you have to understand when it comes to getting a mortgage is you might potentially want to refinance out of your mortgage in the future. So I mentioned this a little bit earlier in this video. If you get a government mortgage, you might have to pay a little bit higher interest rates, and you might have to pay additional insurance on your mortgage. Now, if interest rates come down and you build more equity in your home, you could use this as an opportunity to refinance into a lower interest rate mortgage and to get rid of some of these fees. That way now you have the home that you're still living in, and all you see happen is your monthly payments drop because you have a better mortgage now. The thing that I want to remind you here, that in order to refinance your mortgage, you need to see property values stay the same or go up. But real estate prices don't always go up. So you want to keep that in mind, because people who were buying homes in the early 2000s, they were buying homes with these low teaser rates, thinking that when interest rates go up, they'll just be able to refinance their mortgage and then get these lower interest rates. The problem was that home prices dropped. So when people went to refinance their mortgages, turns out they couldn't qualify for a new refinance because they didn't have any equity in the homes because their home values dropped. So yeah, refinancing can be a great tool if you can refinance into a lower interest rate mortgage. But you don't want to go into a home thinking, yeah, you know what, I'll make the sacrifice now. That way in 5 years I can refinance into a better mortgage. You don't want to do that because there's no way to predict what the world or what the real estate market or what the housing market is going to look like in 5 years. You don't want to be in that position that people were in back in 2008 and 2009. If you do want to see how to refinance your mortgage and save the most money, the article I linked in the description below walks you through how to do that. But what I'm trying to say is this is why it's so important for you to be able to afford the home that you're buying right now, because you don't want to run in a situation where 5-10 years down the road, home prices drop, or you can't refinance because you thought you were going to be able to, and now you're stuck in a home that you cannot afford. Make sure you can afford the home today and not kind of rely on the stars to align in the future so you can afford the home. A housing market crash is one of the scariest things that can happen to an economy, because we saw what happened back in 2008. When the housing market crashed, our entire economic and financial system was on the verge of collapse. The thing that makes real estate so unique is how big and how kind of interconnected it is with so many different industries. Because not only do you have homes, which for many Americans is the biggest purchase that you will ever make, but now you have the entire banking industry, because the banking industry kind of banks off of people taking out mortgages to buy out homes. And then you have the insurance industry. And so you have this major kind of system that is built around the entire real estate industry. And so if real estate prices come down, or if real estate prices crash, then the whole industry goes down with it. And that's why you can see kind of the whole financial system suffer if housing prices or real estate prices crash. The thing that you have to understand about real estate, and every asset class for that matter, is that real estate moves in cycles. There's times where home prices are booming, and then you'll see times where home prices are cooling down. The 2008 real estate meltdown was an outlier because that wasn't just a crash. I mean, that was an all-out real estate collapse. But at the same time, you really want to understand what's going on in the real estate and the housing market right now, because we are in a very strange housing market. And so you want to make sure you're protected, and you want to make sure you really understand what's going on. That way you can make the best decisions with your money, and that's what I'm going to be talking about in this video. But before I do that, I need you to do me a quick favor and smash the thumbs up button below. If you really want to understand what factors could cause a housing market crash, there's 3 things that you need to understand. understand. First, you got to understand where we were, because that's going to help you understand how we got to where we are. And that's going to help you understand, number two, where we are today. You need to understand where we are in the housing market and the real estate market. And that's going to help you understand, number three, where we are going. So let's start with number one. Let's talk about what happened to get us where we are today. So like I said just a second ago, real estate is cyclical. And after 2008, it wasn't just a normal cycle like this. During the 2008 crash, we really saw real estate just collapse like we have never seen happen before. And so here was 2008, and in 2012, so we'll call this 2012, that was when real estate prices really bottomed. So the 2008 crash started in 2008, and real estate prices bottomed out in 2012. And then from 2012 onwards, between 2012 and 2019, we saw the real estate market start to improve. We saw jobs start to come back, the economy grew as more people got their jobs back, more people had incomes to go out and buy homes. So home ownership started to grow. We saw lending restrictions start to relax, and so more people were able to go out and get a loan so they could go out and buy a home. And so we started to see home ownership rise. We started to see more people buy homes, and we saw home prices start to really go up. Then in 2019, something really interesting happened. 2019 was supposedly one of the strongest economies that the United States has ever seen. But at the same time, the Federal Reserve Bank in 2019, they came out and they started cutting interest rates. Now, typically, the Federal Reserve Bank only cuts interest rates when you are in a recession, in a slowing economy, because when you cut interest rates, it makes borrowing money cheaper, and when borrowing money becomes cheaper, more people go out and borrow money so they have more money to spend. So cutting interest rates is a way for you to stimulate the economy. And so it was kind of strange that in 2019, we started to see interest rates cut. And the reason behind that was the government and the Federal Reserve Bank was kind of concerned about the economy because it was growing, but they were concerned that it wasn't growing as fast as they would have liked. So they started cutting interest rates to kind of get that economy moving faster. And so in 2019, we started to see mortgage rates fall, which naturally made more people want to be homeowners. So in 2019, we kind of saw this kind of dip and then jump back up because now mortgage rates started to be cut. And so these lower interest rates made more people want to be homeowners. And now we go into 2020, and as we all know, in 2020, that's when the pandemic hit and the recession hit. And for a little bit of time, everything shut down. People stopped buying real estate, people stopped selling real estate, everything was shut down. But then a month after the pandemic came in, that's when the Federal Reserve Bank came in and they slashed interest rates to near zero. And as soon as that happened, so this is like mid 2020, now home ownership started booming because you had these kind of the early adopters that saw this and they were like, wow, you're telling me that I can go and get a 30-year mortgage for 3% interest? And so all these people started to go out and they started to buy homes. And at the same time, you didn't have a lot of homes available for sale. I mean, some people just didn't feel comfortable selling their homes because we were in the middle of a pandemic and they didn't want people walking through their properties. And so you had a small inventory of homes available for sale, and you had a lot of people that wanted to buy homes and take advantage of these low interest rates. So now the home market started to boom. Then as housing prices started to go up, people were saying, wow, I don't want to miss out on this trend. And so more and more people started buying homes. You started to see some more people start to sell their homes. But even through 2020 and 2021, we had a very small supply of homes available for sale, while we had a whole kind of tidal wave of people that wanted to be homeowners because people wanted to take advantage of these low interest rates. I mean, even at the time we were recording this video, interest rates were dirt cheap. And so going from 2020 to 2021, we saw the housing market essentially just shoot up. From 2012 to 2021, it was a very great time for homeowners. I mean, if you bought a home around here, you saw home prices shoot up straight. So between 2012 and 2021, home prices just shot up thanks to the help of loosened lending restrictions. So it became easier to go out and get a mortgage, and thanks to the help of cheaper mortgages because the Federal Reserve Bank started cutting interest rates in 2019. And then we saw it in 2020 get slashed even more to historic lows. And so we are seeing some of the lowest interest rates ever, which made it very enticing for people to go out and buy a home. So from 2012, 2021, we saw a booming housing market. market. This brings us to where we are today. Right now, at the time when we're recording this video, we are in the midst of a real estate boom. So we're still in a seller's market where we have a lot of people that want to buy homes, but not a lot of people selling homes. And so home prices are shooting up. But you really got to understand these 5 things if you want to be able to understand really where we are right now in the housing market, because that's going to lay the foundation to understand where we're going in this housing market. Starting with interest rates, the thing you have to understand about interest rates is interest rates determine how expensive your mortgage is going to be. And so this housing market has been driven primarily, or at least in big part, because of low interest rates. People have been trying to take advantage of these cheap mortgages. And right now, mortgage rates have come up a little bit, but they're still historically very low. So while interest rates have come up a little bit off of their lows, they're still nowhere near as high as they used to be. So interest rates are still very low, but people are concerned here. Because if interest rates keep going up, then people are worried that it's going to become very expensive for someone to buy a home, because we've seen home prices boom. And so we have home prices way up here, but people are still able to afford homes because interest rates and mortgage rates are so cheap. But if mortgage rates come up and home prices are so expensive, then people will not be able to afford homes. So that's the concern. But now the counterpoint is the Federal Reserve Bank has come out time and time again, and they said that they're going to keep interest rates low for as long as possible. Now, what's as long as possible? I don't know. I mean, some people say that they're going to keep it low through the end of 2021. Some people say through the end of 2022. Some people are saying into 2023. So it really just depends on how fast the economy is growing, because it's really hard to predict what the Federal Reserve Bank is going to do. All we know is they do want to keep interest rates low for now, and we don't know how long these low interest rates are going to stay. But as long as interest rates are low, you can kind of predict that people are going to want to take advantage of these low interest rates to go out and buy a home and to refinance on their mortgage, because they want to take advantage of this cheap debt. The thing that everybody's worried about here with interest rates is what is the breaking point? And this is what the Fed is trying to test. And so as you see them kind of slowly raise interest rates, what they want to see is where is that kind of breaking point where now interest rates have gone up to the point where people don't want to go out and buy a home, or people don't want to go out and refinance their mortgages. Where is that point? I don't know where that is. And I don't think the Federal Reserve Bank does either. They're trying to just kind of figure this out, because if they start to see the housing market start to slow down, or if they start to see the economy slow down because interest rates have gone up so much, well, that could be a problem. And we're in an economy where right now, the economy still is relying on cheap debt and free money in order to keep pumping and surviving. And so interest rates are going to play a major factor in the housing market. And so this is something you definitely want to pay attention to with interest rates and where they're going. But this is something you got to understand, that right now, interest rates, yes, they've gone up a little bit, but they're still at historic lows. This is where you're kind of seeing almost like a perfect storm in the housing market, because not only do you have super cheap interest rates, we also have a very low supply of homes available for sale. And so when you go out and you want to go find a home you want to live in, you might find a beautiful property and you go look at it the same day this property was listed. Well, if you go back and you talk to your spouse about buying this home, and the next day you put an offer, you might find out that there's already 15 offers on this property, and now if you want to buy it, you have to bid up the property. You might be overpaying for this property. So if this property is on sale for $300,000, you might be making an offer for $320,000. That way you have a chance to compete. And so this is what we're seeing happen right now. We have a very low supply of homes available for sale, and so when people want to buy it, because we have such a high demand, people are having to fight against each other through money by throwing more money at the property. And so people are bidding against each other to buy properties because we have such a low supply and we have such a high demand to buy a home. If you bought a home recently, or you're looking to buy a home, or you did any renovations at your home recently, then you've seen this in effect. Because right now, not only do we have low supply and high demand, but we also have a real kind of large labor shortage and a very expensive cost of materials right now, which is causing this kind of low supply and high demand to be even more exacerbated. Because right now, if you want to go and get work done in your property, it is very expensive, because everybody is trying to renovate their homes and everybody's trying to build a home to make up for this high demand. And there's not that many people out there that are working. And so in order to compensate for that, all the construction workers, all the laborers are demanding more money. And so this is causing the price of real estate to go up even more, in addition to the high demand and low supply. And on top of that, we also have a kind of a material shortage, which is causing the price of things like lumber to go through the roof. This pandemic really backed up a lot of industries. And so now, although yeah, we have low supply and high demand, it's also very hard for builders to build homes quickly because we have this material shortage and this this high construction cost because people want more money in order to do the work. And so now you really have this perfect storm because we have low interest rates. We have a small supply of homes available for sale. We have all these people that want to buy a home and take advantage of these low interest rates. And at the same time, now, if you want to build a home, it's taking very long to do that, which is keeping the supply of homes small. And if you want to make renovations on your home, or you want to flip a home so there's more homes available for sale, it's very hard to do that because it's very expensive to do these renovations. And so that is also pushing the price of real estate up, because now if you buy a home and you want to do these renovations, now you have to pay more money to do that just because of this kind of perfect real estate storm that we're in. And that doesn't even include the fact that it's very easy to do renovations right now because everybody's working from home. And so the issue before, if you were in the office and you wanted to redo your kitchen, was, well, somebody has to be home to let the people in or to be there and kind of just coordinate this whole kitchen renovation. But now if you're working from home, you can just work in the living room or the den, and you can have people working in the kitchen. And so people are home, which makes it easier to do these renovations. Couple that with stimulus checks, and so people have some extra money to do renovations. And now you have all these people that want to get work done, but there's a material shortage, there is a labor shortage, and so everybody wants a home, everybody wants renovations, there's a low supply of homes, and people want to buy homes because of the low interest rates. This is creating a real perfect storm, and I'm going to top it off with the refinance boom, because people are refinancing their homes, cashing out with some money, and they're using this money to renovate their homes. But I'm going to get to that in just a second. So we're really kind of seeing a shift in the housing market, because right now we're seeing a lot of people move from the big cities into suburbs because you can work from home. And so this is causing a shift from kind of just the urban renting life to now home ownership life. And we're seeing this kind of suburban sprawl in a way that we haven't seen happen since the 1950s, which, if you remember, was after World War II, when the first kind of major suburban sprawl happened. Now we're seeing all these people move into the suburban parts of cities because people are realizing, well, why do I have to pay $3,000 a month to rent a tiny apartment in a big city when I could pay a fraction of that and own my own home and have an office in my home and own a yard and still keep more money in my pocket? All of these factors coming together have really caused home prices to shoot up faster than ever. The concerning thing now is that home prices have been rising way faster than wages. Now, in a kind of a theoretical utopia market, you would want home prices to rise with wages. So as people make more money, home prices will rise with that. What we're seeing happen right now is very different. We're seeing home prices go like this, and we're seeing wages for some people go down here, while for other people they're going up like this. But in general, home prices are rising way faster than wages because we're still in a recession. We have a lot of people that are still out of a job, but at the same time, home prices are rising faster than ever. And so anytime you see home prices rise so fast, you have to be worried about kind of like a home price correction, because if home prices rise way faster than wages, then eventually these home prices are going to outprice buyers, because people just won't be able to afford homes because homes are so expensive and they cannot afford to own a home with the salary that they're making. And so if people can't afford to own homes, then home prices would eventually have to correct. That way people can afford to own a home again. The thing that makes this so interesting and so tricky is that we are not in a theoretical market. We're in a market that is heavily influenced by external factors, like the government, through things like this forbearance program and this eviction moratorium and a potential $15,000 home buying credit, and through things like easy lending. And so I'm going to talk about this in number 3, but what you have to understand is, yes, home prices are rising way faster than wages, which is very concerning. But the question is, how far can it go? And I'm going to talk about that in just a second. But if you look at this, right, the refinance boom, what you've been seeing happen is home prices have been booming. And so if you bought a home 2 years ago, 3 years ago, you might have seen a 20% jump in your equity in your property just because you own a home. And so if you bought a home a few years ago for $330,000, now your home might be worth $360,000. And so now all of a sudden you have $30,000 of new wealth or equity, at least on paper, in your property. And what you've been seeing happen is people have been capitalizing on this new wealth, this newfound equity in this property, by just refinancing, doing a cash out refinance. Because if you have a property that you bought for $330,000 and now this property is worth $360,000, it really doesn't mean anything to you unless you sell your property, because that money is just sitting in your home. But now if you do a cash out refinance, now you can have this money in your hand at a super low interest rate, and people have been using some of this money to refinance on their homes. But what you've been seeing happen is people have been doing these cash out refinances, which is why you've been seeing this refinance boom. Now look, as somebody who's a money nerd, and as somebody who loves talking about financial education, which is why if you haven't subscribed to our channel yet, make sure you do that. I do want to talk about this just very briefly, because yes, this is still one of the best times in history to refinance your mortgage, because if you own a home and interest rates have come down, Now, you can save a ton of money on your mortgage just by refinancing to a new, cheaper loan. But if you are refinancing, or if you're thinking about refinancing, just make sure you do it the smart way. Because if you're pulling new cash out of your home and you're using this cash to go out on a vacation, and you're using this cash to go out and buy a bunch of nice things like nice clothes and nice cars, you gotta understand you're gonna have to pay this money back plus interest. I want you to use what's going on as an opportunity to build wealth for you, not to make your bank richer by staying in debt for the rest of your life. So if you're gonna go down this refinance route, just make sure you're financing the right way. That means pull out whatever cash you need to pay off your old lender, and now use this new opportunity with these low interest rates to save money on your mortgage every single month, not just to take out a whole bunch of new cash. That way you can have more money to go out and buy a whole bunch of nice things, okay? So if you are doing refinancing, just make sure you're doing it the right way, in a way that's gonna build you wealth, not in a way that's gonna make your bank wealthy. And when you are looking for refinance rates, or if you're looking to buy a home, just make sure you please shop around, because some lenders are gonna charge you a whole lot less in fees and interest than other lenders. So just spend a few minutes to shop around. And the following is an advertisement from our sponsor Credible, who operates a mortgage comparison website. With Credible, you can check pre-qualified mortgage and refinance rates at no charge for you. They have multiple lenders competing on their marketplace, so you can compare great rates and pick the best option that's best for you. The process is simple. All you have to do is go onto Credible's website and enter in a few pieces of information, which just takes a few minutes, and then Credible will present you with actual pre-qualified rates from different lenders. That way you can compare. Credible's pre-qualification process is easy to use. It only takes a few minutes, and checking pre-qualified rates does not affect your credit score. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I got the link to where you can do that with Credible in the description below. Credible does pay minority minus an advertising fee when you submit a pre-qualification request, and Credible Operations Inc. NMLS number 1681276 is not available in all states. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I got the link to where you can do that with Credible in the description below. And this brings us to number 3. Where are we going? So home prices have been shooting up, and many people are worried about a potential housing market crash, or a housing market slowdown, or what's going to happen in the future. Well, the thing that I need you to pay attention to is this one word right here: equity. Because this one factor is going to determine really kind of how risky our housing market is. Because if people have equity in their homes and housing prices come down, we'll be okay. But if people do not have equity in their homes and home prices start to go down, that's where we're going to run into a big issue. And the thing that you have to understand about equity, that there's more to equity than just how much money you're putting down in your property. Back before the 2008 real estate crash happened, what you saw happen was a lot of banks were offering these low teaser rates for people to get a mortgage through a variable interest rate loan. The whole idea was you can come in and get this variable interest rate loan with us, and you have to put down very little equity into this property, if any at all, but you're going to get this super low interest rate today, and then over time, in the next couple of years, your interest rate is going to change depending on what interest rates are. If interest rates go up, your mortgage rate would go up, and if interest rates go down, your mortgage rate will go down. The whole idea was, if interest rates did go up, you wouldn't have to worry too much about it, because then you could just refinance your mortgage and get a fixed rate loan. The problem was that when interest rates started to go up, home prices started to go down. And when home prices started to go down, now people had no equity in their homes. They were actually underwater on their properties. So somebody bought a home for $300,000. They had zero equity. And then when it came time for them to refinance on their mortgage, they owed $280,000, but the home was only worth $260,000. So now they couldn't sell their home. They couldn't refinance on their mortgage because they didn't have enough equity in the property. And so now you were stuck with this super expensive mortgage, and you had no way to make your monthly payments. And so people were just walking away from their homes because they had nothing to lose. But if you have equity in your home, you're not just gonna walk away. If things go wrong, then you can just sell your home, or you can refinance, because now you have equity. And so if people have equity in their homes, you are not going to see a major housing market crash. But if you start to see this equity fade away, that's when you need to start getting worried. Right now, at the time I'm recording this video, you can buy a home with as little as 3 or 3.5% down, depending on what kind of mortgage you're getting. And if you're going VA, USDA, sure, you can get a 0% mortgage. But for kind of the general population, a conventional mortgage is going to require a minimum of 3 to 5% down, and an FHA mortgage is going to require 3.5% down. The things that you want to pay attention to is, if the housing market starts to cool down, what do banks do? Are banks going to lower their down payment requirement? If you see that happen, that's going to be a red flag, because that would mean that instead of having 3% down, which is still already very low, but they're going to say, you know what, you can come and buy this home for 1% down, or 2% down, or even 0% down. And so if we start to see that happen, then you're going to start to see people buy homes with less equity. Now, it's going to be good for a short period of time because you're going to see more people able to buy a home, but over the long term, that's very concerning because people are not going to have that much skin in the game. The second thing you have to pay attention to is if the housing market starts to correct a little bit and you see home prices come down by 5% or 10%, then the people who bought a home with 3% down or 3.5% down are now going to be underwater on their mortgages, and that could be a problem. But it's not going to be like 2008, because right now a lot of people are not getting variable interest rate mortgages because thankfully we are already at historic lows. And so I think a lot of people understand that if you get a variable interest rate mortgage, then as interest rates start to go up, then your variable interest rate mortgage is going to go up too. The thing that I'm concerned about here is as interest rates start to go up, people might get attracted by the idea of a low teaser rate now, because if interest rates go up a little bit, then you're going to think, man, I wish I would have gotten a mortgage 6 months ago or a year ago. And that's when the banker might say, yeah, but you know what? We can extend an even lower interest rate right now if you accept this variable interest rate mortgage with a teaser rate. Now, I don't know if this is going to happen. This is just me speculating. But if you start to see that happen, that's another red flag, because when you are at rock bottom lows for interest rates, the only way the interest rates can move is up. I mean, even if you go out and you buy a $300,000 home right now and you only put down 3 or 3.5% equity and home prices drop 10%, you should still in theory be okay, because if you bought this home with a fixed rate mortgage, the amount of money you have to pay every month is not going to change. And so this is kind of different than 2008, because in 2008, the amount of money you'd be paying every month would be going up while the value of your home was going down. Now, even if home prices go down, the amount of money you have to pay every month, assuming you have a fixed rate mortgage, is going to stay the same. So that's going to play a big part. But when people don't have equity in their homes, or when people are underwater on their homes, then it's easier for someone to walk away because they just don't have the same skin in the game. At the same time, another thing that you want to pay attention to here is the refinancing side of the equation, because as people are doing this cash out refinance, you also want to pay attention to how much money are people pulling out of their homes. Because if you bought a home for $300,000 and you only owe $200,000 on it, and now this home was worth $350,000, and now this person goes out and they pull out $320,000 out of their home, so you have a whole lot of cash in your hand, and now you owe $320,000 on your $350,000 home. Well, if home prices do go down and everybody's doing this cash out refinance where they're pulling all the equity out of their home, and now home prices go down, you're going to see a whole new wave of people that are underwater on their homes. Now, again, this is just speculation, but this is something you want to pay attention to. If a lot of people, which they are, a lot of people are doing this cash out refinance where they're pulling all the extra equity out of their homes because they want to take advantage of this newfound wealth, or at least wealth on paper. The next thing that you want to pay attention to is the shift in supply and demand, because right now we have a lot of homes under construction. And I think we have a lot of people that are kind of getting excited about this new kind of home boom, and more people are starting to sell their homes, especially as we get into the summer. And so chances are we are going to see a bigger supply of homes available for sale. Now, people have been building homes very slowly because of the material shortage and the labor shortage that I just talked about. But over time, you're probably going to see the supply of homes start to go up. Now, at the same time, as home prices keep going up and as mortgage rates start to go up, you have to think that the demand to buy a home will kind of go down a little bit. Now, this is where things are really kind of tricky. It's like an onion with a whole lot of layers to it, because the government doesn't want to see people stop buying homes, and banks do not want to see this demand go away. And so this is where we are talking about a lot of regulation changes to kind of keep boosting this demand. Because right now, the main people that are buying homes are people that have benefited because of this pandemic. So people that didn't lose their jobs, people that might have gotten bonuses or pay raises because of this pandemic. But at the same time, we have a whole kind of group of people that were really hurt by this pandemic, and they weren't able to capitalize on this housing market or these low interest rates and buy a home because they were hurt by that pandemic. And so this is where the government's coming in, and they're trying to do things like pass a free $15,000 home buyer credit for first-time home buyers, where if you want to buy a home and you can't afford the down payment, well, the government's going to give you $15,000 for free as a tax credit. That way you can go out and buy a home. At the same time, you might see other kind of incentives created by banks, maybe lower down payment requirements or other things like that, that was easier for you to buy a home. And so, yeah, in theory, if nothing else were to happen, chances are you're going to see the demand to buy a home start to drop, because as home prices go up and mortgage rates go up, you're going to see less people naturally want to go out and buy a home. But now to combat that, you might see other kind of regulations changed, which would increase the demand. And as the economy opens back up and as more people get jobs and make more money, that could also boost up the demand. So in general, we will probably see an increase in the supply. What's going to happen to the demand? Well, it's a big question mark. In theory, if nothing else were to change, demand would go down. But the government and Wall Street do not want to see that demand drop because it would affect our economy in a very bad way. And the last thing that I want to mention here is that there's a difference between a home price slowdown and a home price correction. Because a home price slowdown is we see home prices go like this, and then home prices kind of start to grow slowly. And so in a home price slowdown, home prices are still going up, but they're just not going up as fast as they were. A home price correction is when you see home prices go like this and then they start to go down. So I want you to keep that in mind because chances are you're going to see a lot of emotional headlines come out where you're going to start hearing about a home price slowdown because it's just natural that home prices cannot just go shooting up forever. And so naturally, we're probably going to see a home price slowdown in the near future. Does that mean that we're going to see a home price correction? Well, personally, I don't think we're going to see this correction, at least not in the near future, at least not in 2021, because we have so many factors that are boosting this housing market. And so I still think that we're going to continue to see this kind of record home price growth, but it just may not be as fast as it was. Now, this is again where it goes back to what government factors are we going to see? What bank factors are we going to see change? How good is our economy doing? How many people have a job? How much money are people making? All these things are going to affect the housing market. But one thing that I want you to pay attention to and understand is that even if home prices are slowing down, that doesn't mean that home prices are going down. Home price slowdowns mean that home prices are going up, just not as fast as they were. Home prices going down means the home prices are going down. So just keep that distinction in mind because you're going to see a lot of emotional headlines come out over the next year and 2 years because this housing market is going to continue to be very strange. And I'll try to keep you updated on our YouTube channel, but this is where you just want to understand what's really going on in the housing market and what's not happening. The only people that rent are losers and broke people. If you want to build wealth, you need to buy your home, that way you can start building equity. You've probably heard something like that before. But if that's so true, why is the fastest growing demographic of renters rich people? More rich people are going out of their way to rent their homes now than ever before. So either all your friends that keep nagging you to buy a home are all millionaires, or rich people know something that we don't. Well, I'm gonna be going over those secrets. In this video, I'm gonna be going over the real cost of owning a home versus renting a home, and then I'm gonna be going over what you need to know before you can actually afford a home. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. Let's assume that you want to buy this beautiful $400,000 house. So I'm gonna draw you right here, gotta give you a nice mustache. So you wanna buy this $400,000 house, and let's assume the interest rates are 3% a year and you get a 30-year fixed rate mortgage. If you do that, this house is gonna cost you $1,300 a month for your mortgage. If across the street this exact same home was listed for rent, it would be renting for $2,500 a month. It's gonna cost you $1,300 a month to buy this house and $2,500 a month to rent this house. If you look at just these numbers alone, you would say obviously it is cheaper to buy this home, but it's really not so simple because you forgot to look at 5 different factors. You forgot to look at property taxes, maintenance, the cost of capital, your personal income taxes, and what I call your 10-year plan. Let's start with number 1. Property taxes. When you rent your home, you're not paying property taxes. It's included in your rent. When you buy your home, property taxes are separate. A simple rule of thumb is you can assume that property taxes will be 1% of your total home's value. So $4,000 a year, which adds up to $333 a month for property taxes. Just so you know, this 1% rule for property taxes is just a rule of thumb. It could be more or less depending on where you live, but it gives us a good idea for this example. Second, let's take a look at maintenance, because when you rent your home and you break your toilet because you ate You can fill in the blank. Your landlord is the one that has to come and pay the bill to fix your toilet. When your roof gets old, your landlord has to fix it. When your furnace gets old, your landlord is the one who has to pay the bill. When you own your home, you're responsible for all the repairs, upgrades, and maintenance. Like every 20-25 years, you might have to put on a new roof that might cost you $25,000. Every 20 years, you might have to put in a $5,000 furnace. Every 15 years, you might have to put in a $4,000 AC, plus kitchen remodels, plus bathroom repairs, plus windows. Add that all up and you can add in another $350 a month for maintenance and repairs, assuming you're not doing major upgrades to the property. Now, this doesn't mean that every single month you're gonna have $350 going out to do maintenance on the property, but over the long run, owning the home, you can kind of estimate about $350 a month for a house this size. Third, you have to look at the opportunity cost or the cost of capital, because when you bought this home, you had to put 20% down, which is $80,000 on a $400,000 home. If you don't have $80,000 to buy this home, then you're going to be paying PMI. I'll get to affordability for homes a little bit later in this video, but you put $80,000 down to buy this home, and the $80,000 is money that you could have put into the stock market. It's money you could have invested into a business. It's money you could have used to buy an investment property, but you used it to buy your dream home. So there's an opportunity cost that you have to weigh. Think of it this way. Let's assume you have $1,000 in your pocket, and there are only two things that you can do with this $1,000. You can go to the store and buy a really nice scarf, or you can invest this $1,000, and in 2 years, this $1,000 will be worth $2,000. So if you go and buy the scarf, not only are you losing the $1,000 that you have to spend for the scarf, but you're also losing the opportunity to make that extra $1,000. So you're actually losing out on $2,000 because it's the cost of the scarf, the $1,000, and it's the $1,000 opportunity that you lost. It's the same with your home. You had $80,000 in your bank account, and now that you use it to buy this home, you can't use that $80,000 to invest in the stock market. And let's assume that you can get a 5% return on your money in the stock market. Now, the average return in the stock market is between 7 and 10% a year, but I'm being conservative. If you can get a 5% return a year on your stock market, that means you're losing out on the opportunity to make something like $4,000 a year. So the opportunity cost of you taking this $80,000 and putting it into this home, as opposed to taking this $80,000 and putting it into the stock market, where you would make $4,000 a year, which is another $333 a month, is the opportunity cost you are losing of $333 a month, because if you put this money into the stock market instead of your home, you'd be making an additional $333 a month. At this point, many of you are probably thinking, but Jaspreet, that's not a fair analysis. The value of your home is going to go up too, because your home is an investment and real estate never goes down in value. Now, I get it. I'm a real estate investor. I have purchased properties that have doubled or tripled in value in a very short amount of time. So if your property goes up by 4% a year, then this $333 a month that you're losing in opportunity cost is recovered through appreciation in your home. But it's really hard to calculate that, because you're not buying this home for the sole purpose of making money. You are buying this home as a place to live, not as an investment. You're buying this home to live in and use. You're not buying it to flip. Can you make money on your home? Yeah, absolutely. But remember, you're not buying this home to get rich. You're buying this home to use it. If you were buying this property just to make money, then it would be better for you to go out and buy an investment property. That way you can get passive income and the appreciation instead of buying a home to live in. You could very well see that 4% appreciation in the home value of your home, but you don't actually realize or get that money until you sell your home and sell the place where you live. Most people are not buying their home thinking, okay, I'm gonna move into this home, and as soon as my property value goes up by 20%, I'm gonna sell this home and move somewhere else. If you do, then you can just ignore everything I'm saying, but most people don't. Most people are buying their home thinking, I wanna live here, that way I can raise my family and settle down and make memories. That way they can live in this home and enjoy it for as long as possible, and then they're gonna sell when they absolutely need to sell, or if something comes up. So when it comes time for you to sell, you're at the mercy of the real estate market. You're not selling because you think, oh, property values have gone up, let me sell my home and move somewhere else. If home values are up when it comes time for you to sell, then you're golden. If home values are not up, then that appreciation is not there. Remember, if the 2008 recession taught us anything, it's that real estate doesn't always go up in value. Fourth is your personal income taxes, because when you own your home, you actually get a deduction on the interest you pay on your mortgage. So unlike these three, this interest deduction actually makes the cost of home ownership a little bit cheaper, because every single month when you're paying this $1,300, some of this money is going into your bank's pocket as profit through interest, while the other other money is principal, which goes towards your loan value. Banks are smart and they want to get paid before you do. And what they do is they front load your loans. So out of this $1,300 that you're paying during the first few years of your loan, almost all of this $1,300 is going into your bank's pocket as interest, and very little of this money is going towards your loan principal. Towards the end of your mortgage is flipped because now almost all of your money is going towards the principal value of your home because you paid the bank during the first years of your loan. So during the end of the mortgage is when you're actually getting the real benefit and building equity in your home, and the beginning parts of your mortgage is when your bank is making all the money. What that means is a portion of this $1,300 that you're paying every single month is going to be deducted from your personal income taxes. Now, the amount of benefit that you have from this income tax deduction is going to depend on your tax bracket. The higher your tax bracket, the more valuable your deduction is. In other words, the more money you make, the more valuable this deduction is, and you're going to get a bigger deduction in the first half of your loan than you're going to see in the second half of your loan. So to keep things simple, let's assume that this interest deduction lets you keep an additional $200 a month in your pocket. So based off of these numbers, if we add this up, it looks like the total cost for you to own your home is actually closer to $2,116 a month. So based off of these numbers and compared to this rent payment, which can vary based on your area, it looks like based off of these numbers, it is cheaper to own this home based off of these numbers compared to this rent. But we're still not done yet. Before we get into whether you can actually afford to buy your home, let's talk about number 5, your 10-year plan. Because as somebody who is a real estate investor and as somebody who used to work actively as a real estate salesperson, I can tell you that buying and selling your own home is a big deal. This isn't something that you're just gonna do in your free time when you feel like it. When we're talking about buying or selling your dream home for your family, it is always on your mind. You're always looking at home prices, you're always thinking about mortgages, you're always thinking about how you're gonna move your property. Owning your home takes work, it's time intensive, and it locks you down. It's not something you can just leave with a snap of a finger. If you plan on living in this home for 10 years, then it's no big deal. But if you're not sure if you're committed to the area where you're buying, or if you're not sure if you're even gonna be there in 6 months or a year, is it really worth all that headache to buy a home when you might be moving out in just a few months and you have to sell this property again? When you rent a property, you're not tied down. You can just break your lease and move if you really needed to. When you're leasing, you have the flexibility to live in new communities and try different homes and see what you really like and where you want to live. It's hard to put a dollar figure on this 10-year plan, but it is definitely something you want to consider because there's a lot of time involved and there's a lot of brain power involved when it comes to moving out of a home that you own as opposed to a home that you rent. So based off of these numbers and these mortgage rates and this down payment, it is cheaper for you to buy this home than it would be for you to rent this home. But if the going rental rate for this same property was $2,000 a month as opposed to $2,500 a month, then it would be cheaper for you to rent this home than buy the home, which is why you need to do the numbers. But you also want to take a look at whether you can afford to buy this home. So when it comes to actually buying your home and saving the most money when you buy your home, we have tons of articles on this on our website, theminoritymindset.com. I'll also link an article for you up here and in the description below. But when it comes to actually affording your home, there's 5 things you need to take a look at. You want to look at how much savings you have. You want to look at how much money you have for the down payment. You want to look at your debt to income ratio. You want to look at your credit score, and you want to look at how much money you have put aside for your investments. Let's start with number 1, your savings. If you don't have any savings, like the majority of Americans, you cannot afford to own your home. And when I say you can't afford to own your home, I don't mean that you're not going to get approved for a mortgage. I mean you can't actually afford it for your own personal wealth. If you go out and you buy your own home without any savings, you are putting your future financial freedom at risk. I own a lot of real estate, and I can tell you that with real estate comes repairs. Anytime I buy a property, I do multiple inspections. First, I inspect the property, then I hire a private property inspector. Then the city inspector inspects the property, then my contractor inspects the property, and then my property manager inspects the property. I go through 5 different inspections anytime I buy a property. Still, things break and they go wrong. It is not cheap to fix an electrical issue, it's not cheap to fix a plumbing issue, and it's not cheap to fix a foundational issue. The reason why I'm emphasizing this so much is because 65% of Americans are homeowners. So if this chart represents America, 65% would be 25%, 50, 75, so 65 would be something right around here. So this is 65% of America, and these are the homeowners, which means 35% of America are renters. Well, at the very same time, 70% of Americans do not have $1,000 saved up for an emergency. So let's look at this from the best case scenario. Let's assume that all of these renters, this 35% of America, do not have $1,000 saved up for an emergency. That means there's still another 35% of America that does not have $1,000 saved up for an emergency. So remember, this is 65%. So now, if another 35% of this 65 does not have $1,000 saved up for an emergency, that is more than half of the homeowners in America. So only 30% of Americans have $1,000 or more saved up for an emergency, and that means that the very best case scenario is that 1 out of 2 homeowners have $1,000 or more saved up for an emergency. Half of American homeowners do not have $1,000 sitting in the bank account to protect them from a broken pipe. Remember this chart next time your cousin Bunty tells you, yo man, you have to own a home because the mortgage payments are so much cheaper than rent. Yeah, your mortgage payment is less than your rent, but your credit card bill to fix your plumbing isn't. Let's talk about your down payment for a second. Do you want to know who wants you to own a home besides your cousin Bunty? The government and your bank. And what they do is they make it more accessible for Americans to own a home by reducing how much of a down payment you need. Doesn't that sound nice? Home ownership is more accessible for Americans. So what do? They lower your down payment requirement. That way you can buy a home with little to no down payment. There's only one problem with that. People who can't afford to own a home shouldn't own a home. Why? Because they can't afford to own a home. Now, just because you can't afford to own a home today does not mean that you can't ever own a home. It means you can't afford to own it today. I want you to be able to own your home and be able to afford it. Because if you can't afford to own your home, then what happens is your home ends up owning you. Do you want to know what happens when you have a ton of people owning a home who can't afford to own a home? You get a repeat of 2008 because real estate prices don't always go up. And so now, if the economy slows down and you have a ton of people who can't afford their homes, then these people are going to have to walk away from their homes because they don't have the means to protect themselves from an emergency. And so then you have a real estate crash. If you want to afford the home that you're buying, you need to have a minimum 20% down payment. So if you're buying a $400,000 home, you need to have $80,000 in cash to put down to buy the home. And it's not just me saying this. Your bank is saying this too, just indirectly. Because if you don't have 20% to put down on your home, your bank charges you an extra fee called PMI. PMI is mortgage insurance, but it's not mortgage insurance for you. It's mortgage insurance for your bank that you have to pay. See, your bank is kind of worried that they're going to have to foreclose on you because they know you don't have the money for a solid down payment. And so if the bank forecloses on you, they're going to lose a lot of money. So what do? They make you buy the bank's insurance through PMI if you don't have enough money for a solid down payment. Debt to income. If you have a lot of credit card debt and student loans and a car payment, you should not go out and buy a home because the solution to your debt problem is not going out and taking on more debt. But Jasprit, my cousin Bunty told me that buying a home makes me wealthy because I'll be building equity. The solution to debt is not more debt. Right now, you need to rent a small place and use all of your extra cash to pay down this excess debt that you have. If you have credit card debt, your credit card company is skinning you alive. And right now, your sole focus should be to pay down your high interest debt. That way you can afford to buy a home. Just because you can't afford to buy it today does not mean that you cannot afford to buy it ever. You need to get your money right. That way you can buy a home and actually afford it. That way you can enjoy your home. Fourth, if you have cash in the bank, you have money for a down payment, and you have very little debt, but you have a bad credit score, then your bank is going to charge you twice as much as they're going to charge somebody with a perfect credit score to buy the exact same home. I get it. You want to buy a home and you want to buy it right now, but this credit score is going to make it way more expensive than it needs to be. So fix that first. That way you can get a good rate on your mortgage. And fifth is your investment cash. Lots of people fall into this trap of thinking that my home is the biggest investment. And so what they do is they go out of their way to buy the biggest home possible. And then anytime you have extra cash, you use it to renovate your home and you buy new things for your home because you keep telling yourself that your home is an investment and your goal is to one day be able to live off of the equity in your home. Owning your home is great. And it's really nice not to have a mortgage, but you do not want to fall into the trap where all of your money is going into your home because you think that is going to be the reason why you get to retire and be financially free. buy investments, build income streams. It will give you a better return and it will let you sleep a whole lot easier. Plus, when you have investments outside of your home that you live in, then you can make money without having to sell the roof over your head. Now, before I get into the next clip, I do want to let you know that if you are interested in learning more about how you can start generating passive income, our team has put together an amazing guide that walks you through different passive income strategies. That way you can start putting your money to work to start generating you passive income right now. So if you want to read this guide for free, I got the link to how you can download this guide and get our free daily newsletter by using our link in the description below. Buying a home is not always the right answer. I mean, sometimes it's cheaper for you to rent than buy, and sometimes it's less stressful for you to rent than buy, and sometimes it's more flexible for you to rent than buy. Buying a home is a big decision, so you want to make sure you're ready to buy a home. I already made a video where I went over everything you need to know about actually buying a home. So if you want to learn more about that, I will link that video for you in the description below. But in this video, I want to talk about the reasons why you should not buy a home. I'm going to be going over the 5 reasons why you should not be buying a home. But before I get into these 5, I need you to sit back and feel at home by smashing that thumbs up button below. The first reason why you should not be buying a home is if you do not have enough money saved up in your bank account. And when I talk about your savings, I'm not talking about your down payment. I'm talking about actual savings in reserves in your savings account in cash. That way, if something were to happen, you have money to fall back on. Now, typically, you want to have at least 3 months worth of expenses saved in your bank account. So if you're spending $5,000 a month, you want to have at least $15,000 a month extra in your savings account before you even consider being a homeowner. I used to be a real estate salesperson and I'm a real estate investor. And one thing about homes is things break. And when things break, when you're the homeowner, you have to pay for it. I live in a northern home where it gets cold and it falls below freezing during the wintertime. And one of the things about the cold winters is you can see the pipes, the plumbing pipes burst because of the cold. That's exactly what happened to a rental property of mine last year. I had a home where a tenant was living and everything was fine. They had the heat on, but it was so cold that underneath the house, under the crawl space, the pipes froze and they actually burst. This was an unexpected expense. Luckily, we were able to get the water turned off quickly because the water was spraying everywhere, but it cost us thousands of dollars to fix the damage and to fix the plumbing and to put in new insulation. That way this doesn't happen again. When you're a homeowner, you have to be prepared because pipes burst, they clog, windows break, ACs bust, and furnaces go out. And when that happens, you need the cash to fall back on. And if you don't have any savings, then you're gonna have to go into debt in order to fund these repairs just because you wanted to be a homeowner. Now you're paying interest to fix your window. Before you go out and start thinking about buying a home, I need you to first save some money. That way you can afford these emergencies when they come your way. The second reason why you should not buy a home is if you cannot afford, keyword afford, the down payment. So this point is not gonna make my realtor friends or my banker friends very happy because there's a difference between being able to afford your down payment and just being able to make your down payment. If you go to a real estate agent and you tell them that you want to buy a home, they're going to try to find you the best home possible. Typically, the best home possible is also the biggest home possible, and coincidentally, the biggest home possible also gives your real estate agent the biggest check possible. So your real estate agent is in the business of trying to get you a home. Your banker's job is trying to get you finance for the home. So your banker, also like your real estate agent, does not get paid unless you actually buy the home. So your banker is going to try to do everything they can to get you a mortgage to buy a home, even if you can't necessarily afford the down payment, because the bank has a very different definition of what it means to be able to afford a down payment. Your bank's goal is to become wealthy. It's not for you to become wealthy, it's for the bank to become wealthy. And the way the banks get rich is by lending you money and having you pay interest on this money for the rest of your life. So the bank is going to try to do whatever they can to give you a loan, even if that's not necessarily the best thing for you. And your real estate agent's job is not to look out for your financial health. Your real estate agent's job is to find you a home and sell you that home. Your job is to be the one looking out for your wallet. And what a lot of people do is they rely on their real estate agent or they rely on their bank to tell them what they can afford. This is a big mistake. We saw this happen to an extreme during the 2008 crash, because back then, if you wanted to buy a home, you could qualify for a ninja home. Ninja stood for no income, no job, no assets. So if you didn't have a job and you didn't have an income stream and you didn't own anything to your name, you could still qualify for a mortgage. All you had to do was go into a bank and tell them that you wanted to get a mortgage, and they'd say, great, how much money do you want? So you tell them, I want $300,000. And they tell you, no problem. We will give you the $300,000. That way you don't have to put any money down. So no down payment required. And if you sign the papers today, we'll also give you a free TV. Nowadays, you can't walk into a bank and walk out with a $300,000 mortgage without showing your income or a job. However, banks are still gonna try to do whatever they can to help you get a mortgage, even if you can't necessarily afford it. If you wanna be able to afford your down payment, you need to be putting down 20% of the home's value as the down payment. Now, I know what you're thinking. 20%? That's a lot of money. If I wanna buy a $300,000 home, that's $60,000. Yeah, I know, 20% is a lot of money, but if you want to be able to afford the down payment, then you got to be putting down 20%. If you don't put down 20%, then the bank is going to hit you with extra fees and higher interest rates and PMI just because you don't have enough money to afford a 20% down payment. If you're not able to put down 20%, then the bank is going to look at you like a riskier investment, because when the bank loans out money, it's an investment. And so they look at your credit score and they look at how much money you put down, and then they rate you as an investment. Are you a safe investment or a risky investment? If you're a risky investment, that means you're not putting down 20%, then the bank has to make up for the higher risk by charging you higher fees, like a higher interest rate. So now if you don't have 20%, you're going to have to pay more money in interest just because you didn't have enough cash to afford this 20% down payment. And the bank is also going to charge you something called PMI. PMI stands for private mortgage insurance. And essentially what it says is, because you don't have 20% down, you don't have as much skin in the game, so you're more likely to walk away from your home. And if you walk away from your home, now the bank is going to have to foreclose on you and they're going to lose money. And so when you pay this PMI, you're buying insurance, not for yourself, but for the bank. So you're paying for the bank's insurance. That way, if you do walk away from the home, the bank is protected because now they have insurance that you're paying for. If you don't put down 20%, you're buying the bank's insurance, but you can avoid paying that extra fee if you just put down 20%. So when you have enough money to afford the down payment, now you can avoid paying PMI, you can avoid paying the higher interest rates, and you also have more equity in your home. Going along with not being able to afford your down payment, you also want to make sure that you can afford your mortgage payments, your monthly payments, because like I said before, just because you can make your mortgage payment doesn't mean that you can afford it. Back when I was a real estate agent, you'd hear people talk about the 33% rule, which essentially said that you want your mortgage payment to be less than a third of your gross income before taxes. Nowadays, you hear banks talking about the 28% rule, which says you take your monthly gross income, so before taxes, and you take 28% of that. That's how much your mortgage payment should be. But this 28% rule doesn't take into factor your property taxes and insurance. So when you add it all up, it ends up being about a third of your income before taxes. So I guess things haven't really changed. So let's take a look at the numbers. Let's assume that you make $5,000 a month before taxes, and a third of your income, 33% of your gross income, is going towards your housing costs. So this is your mortgage, your property taxes, and your property insurance. That means that you're paying $1,650 a month for your mortgage, property taxes, and insurance. And let's assume that you're putting 10% of your gross income towards your savings and 10% of your gross income towards your investments. So this is a little bit less than what I recommend, but let's go with that for the sake of this example. That's another $1,000 going towards your savings and investments. And of course, you have to pay income taxes on this $5,000 because the IRS wants their cut. And if you're making $5,000 a month, that's $1,100 a month going towards your income taxes, assuming that you're not in a super high tax state like California or New York. If you spend this money on your income taxes, on your savings and investing, and then this much is going towards your housing costs, that's gonna leave you with $1,250 a month to spend on your car insurance, your car repairs, your gas, your heating, your AC, your groceries, your medical bills, your vacations, your birthdays, and everything else. The majority of Americans are living paycheck to paycheck because of how high their housing bill is. That means you don't have this $1,000 going towards your savings and investments, and you can replace that with your credit card bills and your student loan bills. So you don't have no money going to your savings and investments, you have more money going to all of your bills, and you have nothing left over for yourself because you're spending way too much money on your housing payments because that's what everybody thinks is normal. Now what I want you to do is stop thinking like the majority of people, because we're the minority mindset, and start thinking like the minority of people. What I want you to do to be able to afford your mortgage payment is have your mortgage payment be no more than a quarter of your total take-home pay. So if you're taking home $5,000, then your mortgage payment should not be more than a quarter of that. So you got to factor in taxes, and based off of what you keep, then your mortgage payment should not be more than 25% of your total take-home pay. If you already own a home and you feel like your mortgage payments are stretching you too thin, then you might want to consider refinancing your mortgage, because that can be a way for you to save money on your monthly mortgage payments. If you want to learn more about how to refinance your mortgage the right way and save the most money on your refinance, our team put together an awesome guide that walks you through how to refinance and how to save the most money while doing it. You can read this article on our website, theminority.com, and I'll also link it for you in the description below. Fourth, you should not be buying your home as a way to get rich. Many people have this misconception that your home is an investment. Your home is a place where you live in. It can make you money. Many people have made a ton of money by owning a home that had appreciated in value, but you should not treat your home as an investment, because if you really want to get rich and you want to do that by investing your money, you can get a much better return on your money by investing your money into an investment property instead of the home that you live in. Everybody sells the idea that the home that you live in is the best investment that you can make, because that's what makes banks money, that's what makes real estate agents money, that's what makes title companies money, and that's what helps fuel the government, because real estate is the backbone of America. So if more people are buying homes because they think it's the best investment ever, then the whole economy continues to function. However, your home is a place where you live. It is different than an investment. An investment, especially when we're talking about real estate, comes with different tax breaks, it comes with different types of income, and it comes with different benefits. The home that you live in is something that you use. Now, this is something that can make you a lot of money. If you bought your home for $250,000 and it appreciates in value over the time that you live there, and you sell it for $750,000, well, you just made $500,000 in profit. However, you don't want to buy your home with the goal of trying to get rich off of it. This is where you can get into a trap of buying a home for the wrong reasons. Are you buying a home to get rich, or are you buying a home for a place to live? Because if you buy a home with the idea that you're going to get rich off of it, it's much easier to get you to buy a home that you can't afford, with a down payment that you can't afford, with a monthly payment that you can't afford. Now, you're living in this big home, and it looks nice, it looks good on Instagram, your friends like it, but you're stretching yourself way too thin financially, and now if anything happens to the economy, or if anything happens to you financially, now you're underwater on a home that you thought was going to make you rich. Treat your home like a liability. If it makes you a lot of money, great, but you're not buying it to get rich. If you want to get rich, you should be buying an investment property, because now you're buying this property for the purpose of making money, and during the time that you own this property, you're also making income every single month through rent. Buy a home with the goal of living there, not to get rich. If you want to get rich, then invest your money instead. And number 5, you should not buy a home unless you're ready to be a homeowner. Buying a home is a big deal. You shouldn't just buy a home because your mom and dad and uncle and aunt keep saying that you should buy a home instead of just throwing all your money in rent. You need to buy a home when you're ready to buy a home. It's not always cheaper to buy a home than rent a home, especially when you factor in property taxes and insurance and maintenance costs and the opportunity cost of what you can do with the down payment. Buying a home is cool because now you can put it on Instagram and show everybody that you're finally a homeowner, but it also means you got to settle down. Are you ready to settle down in a particular location? Buying and selling a home can be expensive, and it can take a long time. So if you buy a home and then you realize you weren't ready and now you want to sell the home, it could take you 2, 3, 4, 5, 6 months to actually sell the home and find a good buyer. That means your equity and your money in your home could be tied up for a long time as you're looking to sell your home, and if you have to move quickly, that could slow you down. I'm not trying to discourage you from being a homeowner. Home ownership is great, but you just got to make sure you're ready to be a homeowner. Can you afford it? Can you afford the down payment? Can you afford the monthly payment? And are you ready to settle down? If you are not ready to be a homeowner, don't go and buy a home just because everybody else is doing it. You are going to regret that decision later. Instead, rent a home, figure out where you like to live, figure out your money situation, and once you're ready to buy a home, now you can go out and find the dream home that you want and actually be able to afford it. If you enjoyed this video, here's a video on passive income that I think you'll love, and while you're at it, download a free PDF on money management and investing, and as always, keep hustling. The thing about real estate investing, I'll tell you from personal experience, is in the beginning, it is not going to be passive. You have this kind of like hurdle that you have to jump over to understand how real estate investing works. But once you get over the hurdle,